12% yield sounds super tempting, doesn't it? But is this the real deal, or is there something else under the hood? You know what I'm talking about, ETF QYLD that promises 12% annual yield. Let's break this down. Hey guys, Raj here. Welcome to Think Finance, where I talk personal finance, investment ideas, and ways to stretch our money. Hopefully, we all can learn a thing or two from each other. I've received a lot of comments asking for my thoughts on QYLD. It is an ETF that offers up to 12% annually through a covered call strategy with limited downside. Given S&P returns an average 7% annually, on paper, this sounds perfect. 12% annual return, and has done this consistently for the last 7 years. In this video, I'll talk about how QYLD works, analyze some common scenarios that most investors will use with QYLD, and finally wrap it up with some smart ways to use this investment tool. To understand QYLD, you need to understand 3 areas as I see it. Number 1, covered calls. Number 2, dividends, capital gains, and return of capital, or ROC. And finally, number 3, impact on taxes. If all of this sounds taxing, well, it is, but hopefully I can simplify this one complicated ETF. Let's start with covered calls and how it works. I love Apple, and let's say I bought 100 stocks of Apple. Now, I want to make some side income, so I decide to use a strategy called the covered call strategy. For this to work, I need at least 100 stocks. I'm going to give someone, let's say John, an option to buy my stock at a particular price. Let's assume $120, and within a certain period of time, 1 month. I do this by writing what is called a call option, a financial contract that gives John the option to buy my stocks at $120. And for this right to buy, John offers me some money, or a premium. This premium is mine to keep, irrespective of whether John decides to use his option to buy Apple stock or not. Meaning, if he chooses not to buy, premium stays with me. I just made some quick bucks. Feels like John is just throwing away money, right? No. If Apple goes to $130, John will use his contract and buy my Apple stocks at $120 a pop. $10 cheaper than the market value, assuming it still makes sense after deducting his initial cost, which is the premium. This is his gain, but I sold the stock at a cheaper price, which ends up being my loss. If Apple went to $110, he will not buy the stock from me, since it makes more sense to buy it at the market value as opposed to using the contract and buying at $120. His only loss here is the initial premium paid, which becomes my income or profit for me, and I also get to keep my stocks. In this example, $120 is called the strike price. 1 month is the duration of the contract. After that, it expires. After expiration, I can write another contract. I can do this over and over again and collect premium as long as no one exercises the option to buy and I still end up owning the stocks. That, in summary, is the covered call strategy. There are people out there that use this strategy to make monthly income. Of course, it is a bit more complicated than what I just described. But that is where QYLD comes in. They do all the hard work for you. They use this strategy and offer you and I monthly income by way of distribution. Averages around 12% annually. QYLD uses NASDAQ 100 index as opposed to Apple. So QYLD writes and sells monthly NASDAQ 100 calls, collects premium, at the end of the month distributes a portion of the income to investors, and repeats the process every month. The only difference in QYLD world is option cannot be exercised early, unlike the traditional covered call strategy, which means it only matters where NASDAQ 100 finish at the end of the month. Prior to expiration, any market swing that take place throughout the month doesn't matter. You can find more detailed information on their website. Now let's talk distribution, and I promise I'll bring all of this together. Depending on the security, distribution can be classified as ordinary dividend income, qualified dividend income, capital gains, and return of capital. Ordinary dividend is treated the same as income and will be taxed at your current income tax bracket. Qualified dividend have a favorable tax treatment that is lower than ordinary income tax rates. Capital gains is profit from the sale of a stock. You got a stock for $5 and sold it for $8. $3 is your capital gain, which is taxable. How much these gains are taxed depends on how long you held the asset before selling. Less than a year is considered short-term. More than a year is a long-term capital gain. You'll pay more tax on short-term capital gains. Distributions that are return of capital aren't dividends. It is not taxed. A return of capital is a return of your investment in the stock of the company. Basically, it reduces the cost basis of your stock. You got a stock for $100. That is your cost basis. The company offered $10 return of capital. Now your adjusted cost basis is $90. ROC reduces cost basis. Short-term capital gains and ordinary dividends are treated the same as income and taxed at your current income tax bracket level. Long-term capital gains and qualified dividends have favorable tax treatment that is lower than ordinary income tax rates. Here is a good example that brings everything together. Kate purchased 200 stocks with $11 average price per stock. She then sells that at $15 per stock. Her capital gain in this case is $4. Assuming she had the stock for more than a year, she will pay long-term capital gain tax rate. Let's continue with the same example. The stock has an annual distribution of $4, of which $1 is return of capital. Remember, cost basis for Kate was $11 per share. With $1 return of capital, her cost basis will be reduced to 11 minus 1, which is $10. With a selling price of $15, Kate will end up paying capital gain on $5. Sale price $15 minus the adjusted cost basis $10. One thing to note with return of capital is if you hold the security for a long time, it can reduce the cost basis to zero, which means you have been given back all the money you invested. In such a scenario, you'll continue to receive ROC distribution and it will now be taxed as long-term capital gains at a reduced rate. That took some brain power, I'm guessing. Boom. Let's take all this information and summarize this for QYLD in 5 bullets. QYLD uses covered call strategy to generate monthly income for investors. Distribution is not considered dividend but return of capital. Return of capital is not taxed and reduces your cost basis. When cost basis is reduced to zero, any additional ROC will be taxed as long-term capital gains. You will pay higher taxes if you held QYLD for less than a year and lower if more than a year. Publication 550. It clearly states that holding period matters when calculating taxes on ROC and sale of the security. Also discusses how ROC is treated as capital gains once the cost basis hits zero. By the way, return of capital is considered non-dividend distribution in IRS language. It is shown on Form 1099 Div, Box 3. You'll also need to do a Form 8949. Now that you survived all this painful information, let's do some numbers, dive deeper, and take some real scenarios to try and make sense out of QYLD and answer the question whether it is right for you or not. Short answer, it is fine as long as you understand what you're getting into: taxes, ROC, capital gains, all that fun stuff. I took 4 scenarios and did some analysis using a spreadsheet. Scenario 1, short term, you buy and sell QYLD within a year. Number 2, medium term, you buy and sell QYLD within 5 years. 3, long term, you sell QYLD when cost basis is zero. Finally, number 4, long term with distribution reinvestment, if you reinvested ROC. And I've tried to compare all of this to S&P 500 ETF SPY. All of this is a swag, but should give you a decent idea of what to expect. ROC reinvestment got really complicated to model, so I used the Portfolio Visualizer tool to model scenario 4. I made some assumptions. Number 1, initial contribution is $10,000. No additional funds added. Number 2, the NAV price for QYLD does not appreciate and is static. I think it is a fair assumption since most money in QYLD is made via the distribution. If you look at the chart, NAV for QYLD is less than where it started at inception. Number 3, S&P growth rate is 7.2% annually. This is the average S&P has returned if you look back 80 years. Super conservative if you compare it to last 15 years. Number 4, income tax rate is assumed at 24% and long-term capital gain tax rate is at 15%. I believe this should cover most of us out there. Number 5, for simplicity, only scenario 4 tries to mimic distribution reinvestment, and it might be a bit off, but should get pretty close. With that, let's look at scenario 1, short term, where you sell QYLD within 9 months. In this case, ROC collected is $900, 1% per month, and this will reduce my cost basis from $10,000 to $9,100. Assuming NAV price remains the same, I end up with a profit of $684 or 6.84% after accounting for ROC and 24% short-term tax rate. Compare that to SPY, which also offers dividend. Assuming a 7.2% return, I would have made around $510 profit after taxes or 5.1%. Scenario 2, medium term, where I sell QYLD after 5 years. In this period, ROC collected is $6,000, which reduces my cost basis. Assuming I sell QYLD at $10,000, my capital gain is $6,000. Since I had it longer than a year, this will be taxed at 15%. At the end of 5 years, I would have made a net profit of $5,100 after tax, a 51% return. Compare that to 41% return if I had my money in S&P. Scenario 3, long term, where I hold QYLD for a while and my cost basis goes to zero. Since my cost basis is zero, the entire selling price is considered capital gain, and because I held this for more than a year, it will be taxed at long-term capital gain tax rate, which is 15%. So after accounting for ROC and taxes, my initial $10,000 investment would be worth approximately $19,000, a net return of 93%. S&P during the same period would have returned 85% after accounting for taxes on dividends and capital gains. Finally, scenario 4, distribution reinvestment, and I'm not selling QYLD. This ended up being too complicated to model, so I used Portfolio Visualizer to analyze this one. I was able to look at actual data for QYLD since inception. The tool is treating ROC as dividend. Looking at the yield, the distribution makes sense to me. So, a $10,000 investment in QYLD since inception would now be valued at $18,000, an impressive 82% return. When you compare this with S&P, return doubled at 162%. Some observations and thoughts. As of today, any distribution made by QYLD is a return of capital. You need to understand ROC and how it is taxed before investing in QYLD. Hopefully, this video made it clear. While the return sounds tempting, you should weigh out other opportunities. For example, SPY return was double compared to QYLD since inception. QYLD will be a better performer in a flat market since you will be getting consistent distribution whether market goes higher or not. But in a raging bull market, you will lose out on the potential upside. It might make more sense to invest in QYLD in a Roth IRA where you don't have to worry about taxes. ROC can be reinvested to take advantage of the magic of compounding. The problem with IRA, you cannot withdraw until you hit retirement. It's fine in a taxable account as well, but as you can see from the scenarios, yield is not the only reason to invest. In a bull market, you will be missing out on other opportunities with better returns. Also, you will need to deal with complicated tax implications. There is a way to permanently avoid capital gain taxes by not selling and leaving the investment for your kids. Under the federal estate tax laws, there is a provision called step up. So when your beneficiaries receive the security, the cost basis is stepped up to its current value, meaning your cost basis is no longer zero and is now the current market value. Magic. Beneficiaries can sell QYLD at market value and can completely avoid any capital gains. Do some research. It is a legit clause that can be applied today. But you never know when the government decides to change it. Personally, I've decided not to invest in QYLD. I think there are other better opportunities out there, and QYLD comes with a growth cap, which I'm not a fan of. Roth is not an option for me since that would mean I won't have access to the money till I hit retirement. Having said that, it is legit and might be right for you. Just make sure you understand how it works and the tax implications. Thanks for watching. Are you investing in QYLD? Drop a comment below. Would love to hear your thoughts and experience. Like, subscribe. Until next time, peace.